do have some earnings this week, and Nike is a highlight with shares down double-digit % on the year still. Business has an opportunity here to surprise investors. Joining me, David Swartz is an equity analyst at Morningstar, covering the retail sector. David, always good to have you.
Good morning.
Nike, you view as being undervalued. You think it should be closer to where it was at the beginning of the year, maybe even more, but not with much growth, right?
And Nike right now is generating very little sales growth by its normal standards, really just about 1%. So, right now Nike's in a bit of a downturn, and investors have punished the stock, and it is quite a bit down from its highs. At one time I had Nike as overvalued, but now I think it's quite undervalued. And historically, if you look at buying Nike in these periods when it's down, it's really been a good investment to make.
What is the requirement, you think, outlook-wise, to maybe reinvigorate some optimism?
Yeah, I don't think that the quarterly announcement tomorrow is going to be a major event. Nike has a history of beating earnings, so it wouldn't surprise me if Nike did beat the numbers, but the expectations are pretty low. So I think that the more important thing will be the outlook for the next fiscal year. This is the end of Nike's fiscal year, and so they're looking ahead now to fiscal 2025. And I think that we really want to see growth get back into the mid-single digits, which is more normal for Nike sales growth, as well as earnings growth and some margin improvement as well.
Where could the top line growth come from at this point? I know that there were a lot of concerns about China weakness. Could they just get a lift from that economy coming back, or do they need to really have a successful product line or launch?
Nike's really been struggling in all of its regions to some degree. Its business in Europe has slowed down. The European economies have slowed a bit. In North America, Nike has struggled with competition as well as with its wholesale accounts. It's had inventory problems for some time. And then China, so Nike, I think, is rebounding in China, and I think that the growth is picking up there. At some point, I think Nike will return to double-digit growth in China, which is very reasonable considering the growth of the sportswear market in the country.
The athleisure trade, how do we assess what's cool and what's faded out? Because it seems like some of that, just looking at Lulu, for example, which had been described as kind of a problem for Nike for a while. That stock's now gotten a hit. I mean, is there a problem with the style right now?
I think that there has been some changes. I think we have seen some women move away from maybe the tightest form of leggings,
right,
and maybe to more open bottoms. So there have been some changes like that. But Nike and Lululemon as well, they have a large variety of products. So they can adapt to some degree. Now, Lululemon is very well known for leggings, of course, so any move away from leggings would be bad for Lululemon. But I think the bigger concern is just that competition is starting to impact these companies, and that's coming from Nike too. On one of its earnings calls, Nike talked about introducing more leggings at price points above $100, which is a direct attack really on Lululemon, because
Sure.
that's really Lululemon's price point.
What about the bread and butter from the shoes? It seems like Hoka, On. I mean, there's a lot of stuff in the shoe market that's actually doing quite well. Deckers as a company is doing well. There are certainly is demand. People are still buying shoes. It seems like there's some really successful brands out there. Has Nike lost that market for the time being, or what?
I think Nike has fallen behind in some areas, and there has been a concern. There has been a concern that Nike's been way too much focused on how their products are sold and where they're sold, and maybe not so much on the design and the style and the new innovation. But Nike does have a lot of new products coming out, probably after the Olympics in the fall season, and then into next year. So it may be a few quarters before we see the big impact from that, but I do think that Nike still has a lot of advantages.
Does the inventory need paring down? Should we be looking for, because if you're looking for margin improvement, if you're looking for that, I mean, does that conflict with any need to get stuff out that hasn't sold yet?
And Nike has had inventory problems for some time. It really goes back to the COVID period when they had shutdowns, especially in Vietnam, which is Nike's biggest sourcing country. They had way too many shipments at wrong times, and they have struggled to come back from that. It's taken several quarters, but Nike's inventory has declined, and I think it will have to decline some more as well.
Okay, so we're looking for the pickup in growth next year, not for the coming quarter though necessarily. And then Lulu also near the lows. I mean, if you had to pick one of these to buy near the lows, is there an obvious preference?
I think that Nike is a bit cheaper, but certainly Lululemon is a lot more interesting to me than it was when it was over $500 a share, and I had it as very overvalued.
Yes. Yeah.
So, I think they're both great companies. Certainly, they're both leaders in sportswear, and I don't think either one of them has a lot of major flaws. They're both really strong companies.
To your credit, the overvalued analysis of Lulu did ultimately pay out there. So, David, thanks for the catch-up.
Thank you.
Always appreciate the analysis. David Swartz, equity analyst at Morningstar. Let's go to Tom, who's looking at the options and ready to do some trading in Chicago, looking at the Nike options ahead of the report. And we might do a little Lulu trade, too, to stay honest here. Tom, firstly, how are we looking for the options in Nike tomorrow? Like, what's the expected move?
Yeah, implied volatility levels elevated here, Oliver, near 52-week highs. Going into this report, not surprising, big event risk. The plus or minus move is about 7% in the shares, nearly $6.50 either way. And this is stock still down about 13% so far this year. So it's been under pressure, underperformed. Had a pretty good report last quarter, but filled the gap on that one. So you look at what's going to be the catalyst, right? Is it going to be earnings, or is it going to be the Olympics, the Euros, as far as a soccer tournament, the Copa America? There's a lot going on right now. So maybe guidance will be key here going into this. But I looked at a strategy that takes advantage of that higher implied volatility in the near-term options and the dispersion between implied volatilities between different option series here. So I looked at a call calendar, or a call diagonal, call diagonal to the upside, where I'm going to buy something a few weeks out. I'm going to look at the July 19th monthly cycle that expires in about 23 days. I'm going to buy an at-the-money call, the 93 strike call. And then against it, I'm going to sell the June 28th weekly options that expire in just a couple days here. I'm going to sell the 100 strike call. So in essence, the strategy is a $7 wide bullish call diagonal to the upside. About 3.5 weeks in duration on this one. I'm paying roughly a $3.30 debit for a $7 wide call diagonal, Oliver. So that tells you right there there's a big dispersion between implied volatilities. I'm paying $3.30 debit. That's less than half the width of this diagonal. Now, you need the stock to go higher from here. The apex of the profitability is right at or near that 100 strike over the next few days here into expiration. You're buying basically in that July 19th monthly cycle, about a 43% implied volatility on aggregate in that option series. And then selling in the near-term option to June 28th, about 120% implied volatility on aggregate in that cycle. So there's where that dispersion takes place, and that's why the price of the diagonal is less. You can see here from the risk profile, my break even about $93 right about here. Because even if it kind of remains around 93, 94, you're going to get that ability to roll that short option over the next couple weeks into different option series that creates credits, increases that potential profitability also. But this might be the stance you want to take if you think this thing's going to go up about that one standard deviation. But even if it does go up and blows through maybe 105, goes up to 110, you're still going to be profitable on this because you paid less than the width of the call diagonal.
Okay, so if it does make the move quickly, what do you do with the whole position? Do you take the whole thing off?
Well, that's the beauty of the option market. You got a couple days until expiration, but if it does go up towards at or near that 100 strike, implied volatility levels are going to get crushed in the near term, and that'll allow you to buy that short option back, maybe roll it out to the next weekly option series. That creates those credits I talked about. Or if it does go up towards 100, maybe this thing expands to $5.50, $6 where you can just close the whole thing.
Got it. All right. Hey, let's talk some Lulu.
Yeah.
So David seems like he's more interested in kind of like Nike from a immediate perspective, but from a valuation perspective. But it seems like he thinks Lulu's dropped too much as well now.
Yeah, I think a lot of people are saying that. It's got a good base between that 295, 300 level post earnings on this one, down about 40% so far this year. So it's been under pressure. Maybe it was overbought before, but same store sales in the U.S., its biggest market, have been lagging. Those have been relatively flat over the last couple of quarters. So I looked at this a little bit more conservatively. If you want to trade this, I looked at selling a short put vertical that's neutral to bullish, where you can take advantage of, hey, maybe that 300 level is a good base here, and it's not going to test it again to the downside. So looked at that same July 19th monthly cycle, so 3.5 weeks to expiration. and just selling it out of the money, slightly out of the money put vertical. Sell the 305 strike puts and then buy the 295 strike puts. $10 wide short, neutral to bullish put vertical. You're collecting roughly about a $3.50 credit on that. That takes your break even down to 301.50 to the downside. That's nearly 2% below the current share price in there. And that's what you want on this type of strategy, Oliver. This is one of those things that you can do on a repetitive basis, week by week or month by month. If you think the stock's going to stay above a specific point, you're still staying risk defined on this one, but you're collecting a pretty good credit on a $10 wide short put vertical with the expectation it's going to remain above 305 over the next 3.5 weeks into expiration.
All right, fair enough. So Ben, the Lulu selling is done for the moment. Thanks, Tom, for the trades. Appreciate that.